Have you ever looked at the stock market and just felt, I don't know, like you were drowning in information?
Oh, absolutely. Headlines, tips, charts, opinions everywhere.
Exactly. Where do you even begin to figure out what's actually worth investing in? It feels overwhelming.
It's incredibly common to feel that way.
Yeah.
I mean, the noise is deafening.
Right.
Yeah, and understanding the businesses behind the tickers, that feels impossible for a lot of people.
Yeah, it really does. And that's why we're doing something a bit different today on the deep dive. This isn't just, another market update. It's
Mhm.
a special book talk. We're going to try and cut through all that noise using a framework that's designed to simplify exactly this challenge,
Uh,
how to approach stock investing without just, well, getting lost.
and we're diving into the 5 Rules for Successful Stock Investing by Pat Dorsey. What's really cool about this book, I think, is that Pat Dorsey, well, he started Morningstar.
Right.
And he developed these rules basically because he was trying to teach himself how to analyze stocks effectively, back when he was learning.
I love that. That personal journey makes it so much more relatable, doesn't it? He had to build this knowledge himself.
Exactly.
And the book really distills his deep experience and Morningstar's whole approach to fundamental analysis into principles that are actually super clear and actionable, even if you're not some finance whiz.
It just gives you a structured way to think. It helps you move past pure speculation to, understanding what you actually own.
Okay, so let's unpack this roadmap. The book lays out 5 core rules. They sound simple, but, well, they unlock some pretty profound insights when you really dig in.
They really do provide the essential foundation for making informed decisions. Let's list them out.
Okay,
Rule 1, do your homework.
makes sense.
Rule 2, find economic moats.
Moats, okay.
Rule 3, have a margin of safety. Rule 4, hold for the long haul.
Patience.
And Rule 5, know when to sell.
Simple rules, big impact. Let's dive into rule number 1. Do your homework. Now, this sounds obvious, but you said earlier this is where a lot of investors actually trip up.
It really, really is. The book hammers this point home. Buying a stock without understanding the underlying business inside and out is it's a huge mistake.
Why is that so critical?
Well, investing involves uncertainty, right? Lots of gray areas. And you just can't rely on someone else's hot tip or, opinion. You have to do the work yourself, understand what you're buying.
And that work, it starts with the numbers, doesn't it? Understanding the financial statements. The book calls them like essential windows into a company's health.
Exactly right. There are 3 key ones. First up, the balance sheet. You can think of it like a snapshot in time.
Yeah.
Assets minus liabilities equals equity. Basically, what the company owns, what it owes, and what's left over for the shareholders, theoretically.
Okay, so assets. Things like inventory are on there. But the book makes a good point, doesn't it? That the value of inventory can be tricky, like old clothes versus steel beams. Very different.
Totally different. Old-fashioned inventory might be worthless quickly, while steel holds value. And things like investments on the balance sheet. You often have to dig into the footnotes to see what they actually are. Are they safe bonds like Dell used to hold, or something much riskier?
Okay. And goodwill. The book seems a bit skeptical.
Very skeptical. Goodwill often just represents the amount a company overpaid for another company during an acquisition.
Ouch.
Yeah. The book points to examples like AOL Time Warner or HP, massive goodwill write-offs later on. It's often not real lasting value. And for banks, the book stresses that equity, that cushion, is absolutely critical.
Got it. Okay, next statement. The income statement. This one feels maybe a bit more intuitive. Revenue minus expenses equals profit.
It does feel more straightforward. It shows the accounting profit. It matches sales made in a period with the expenses incurred to generate those sales. It gives you that picture of profitability based on accounting rules.
But, and this is a big but in the book, you have to look at the statement of cash flows right alongside it. Why? Why can that tell such a different story?
Because it tracks the actual cash coming in and going out. Real dollars. It strips away accounting things that aren't cash, like depreciation.
Okay.
Think about the simple example in the book, Mike's hot dog stand. He had, $19 in accounting profit,
Yeah.
but $23 in actual cash flow from operations. That difference comes from things like depreciation, sure, but also how the business manages its working capital.
Working capital. Like collecting money from customers, paying suppliers.
Exactly. Accounts receivable, how fast you collect. Accounts payable, how slowly you pay. For instance, if a company like Dell manages to stretch out payments to its suppliers,
That keeps cash in their pocket longer.
right, it boosts their cash flow, even if sales aren't growing. It shows how managing payables impacts actual cash.
And the flip side, if accounts receivable grows way faster than sales.
That could be a warning sign. Maybe they're booking sales but struggling to actually collect the cash. The income statement might look good, but the cash flow tells you something's potentially wrong.
Wow, okay, so you absolutely need both income statement and cash flow for the full picture.
You really do. It's non-negotiable for serious analysis.
Okay, so that's understanding the statements. But homework is more than just the numbers, right? It's analyzing the business itself. Like, where's the growth coming from? The book talks about sales growth versus earnings growth.
Yeah, this is a key distinction. Sales growth, selling more stuff or services, is generally harder to fake. Earnings growth, on the other hand, can sometimes be, well, let's say engineered
Engineered how?
through aggressive cost cutting, maybe share buybacks, certain accounting choices, or even just buying other companies constantly. The book calls that serial acquiring and sees it as generally lower quality growth, unless it's very strategic.
So real growth is more like, Kia selling tons more phones back in the day, or Anheuser-Busch having the power to raise beer prices.
Exactly. Those are more sustainable drivers. So if you see a company where earnings are consistently growing much faster than sales over several years,
That's a red flag. Investigate further, like that IBM example from the 90s the book mentioned.
precisely, it could be what the book calls manufactured growth. You need to understand why. Then you look at profitability metrics.
Right, things like ROA and ROE.
Yep. ROA, return on assets, shows profit per dollar of assets. ROE, return on equity, is profit per dollar of shareholder equity. Basically, how well is management using the money shareholders invested?
And the book suggests aiming for what, like at least 10% ROE for most companies, as long as it's not just pumped up with tons of debt.
That's the guideline, yeah. A high ROE without excessive leverage is a good sign. And then there's the one the book calls the Holy Grail.
Free cash flow, FCF.
Free cash flow. This is the cash left over after all the operating expenses are paid and after the company reinvests whatever is necessary back into the business just to maintain itself or grow.
So this is the real cash that could potentially be returned to shareholders, like dividends or buybacks from mature companies.
Exactly. It's the ultimate measure of value creation, according to the book.
The book uses this idea, a profitability matrix. High ROE and strong FCF is the sweet spot. It used Pfizer as an example, I think.
That's right. But it also points out, quite rightly, that some rapidly growing companies think Starbucks or Home Depot in their early expansion phases, pre-2001, maybe might actually have negative FCF.
Negative is okay.
It can be if they're reinvesting that cash wisely into high-return projects like building profitable new stores or expanding operations. That will generate much more cash later. The key is, are they still showing solid underlying profitability?
Okay, so the reinvestment has to be smart, not just growth for growth's sake.
Definitely. And the book warns about this with that story of Ballantyne of Omaha Beware Growth, driven by temporary or unsustainable industry factors.
Makes sense. Homework also covers financial health. Basically, how risky is the balance sheet?
Yeah, you gotta look at debt, especially for non-financial companies. The book mentions watching leverage ratios, like assets to equity. If it's over 4, or debt to equity is over 1.0, that means they're using significantly more debt relative to their own equity cushion. That increases risk.
So you need to ask, is the business stable enough to handle that debt? Is debt creeping up?
Exactly. And frankly, the book advises if you look at the debt structure and just can't figure it out, maybe walk away. Complexity can hide risks.
Good advice. Okay, last piece of homework. Analyzing management. Why does who is running the show matter so much if the numbers look okay?
Because management makes all the decisions that lead to those numbers. Their incentive, their competence, their integrity, it's all critical.
So what should you look for? Compensation.
Definitely look at compensation. Are they paid primarily for just making the company bigger, which might encourage risky deals, or are they paid based on performance metrics that actually align with creating shareholder value, like return on capital?
And watch out if the goalposts keep moving but the bonuses keep getting paid.
Yeah. Big red flag. Also, stock options. The book is pretty critical of excessive option grants. Are they granting more than, say, 1–2% of shares outstanding each year? Yeah. That dilutes existing shareholders.
And does a founder who already owns a huge stake really need more options?
Questionable, right? The book generally views restricted stock as better than options, partly because the cost is more transparent on the income statement.
What about skin in the game?
Crucial. Does management own significant amounts of actual stock, not just options? And are they holding it or selling as soon as they get it? The book uses that PeopleSoft CEO example. Huge potential options value, relatively little actual stock owned. You want their financial interests aligned with yours.
And it's not just pay, it's character too. Like, are they honest about mistakes?
Yes. Are they candid? Do they make tough accounting choices that might hurt short-term reported results but give a truer picture, like expensing costs properly instead of capitalizing them inappropriately?
Okay. And you need to check for related party transactions, deals benefiting friends or family, maybe buried in the 10K.
You do. And check the board of directors. Is it independent? Or is it stacked with insiders and buddies of the CEO? The board is supposed to be looking out for shareholders. Your last line of defense, really.
Wow, that is a lot of homework, but it sounds completely essential. Which leads perfectly into this next point, avoiding financial fakery. The good news, the book says, is you don't need to be a forensic accountant to spot some big red flags.
That's right. There are some simple, powerful checks. The number one test the book gives. Compare the trend of net income accounting profit with trend of cash flow from operations actual cash.
Okay, what are we looking for?
If net income is rising nicely, but cash flow from operations is flat or worse, falling, stop.
Yeah.
Dig much, much deeper. Something's likely boosting those reported profits without generating real cash. That's a huge warning sign.
What about companies that always seem to have restructuring charges?
If it happens year after year, quarter after quarter, are they really one-time charges? Or are they just normal business costs that management is trying to exclude to make the underlying profit look better? Be skeptical.
And you mentioned serial acquirers before. Their financials get messy.
Incredibly complex, often hard to figure out what's really going on. It can mask underlying problems. The book advises caution there.
What about accounts receivable again? What's the specific check there?
Look at the allowance for doubtful accounts. That's the company's estimate of bills they won't collect. If accounts receivable is ballooning, but that allowance isn't growing proportionally.
They might be too optimistic about getting paid, booking revenue they won't actually collect.
Exactly. It inflates current profits. Also, watch out for companies padding operating income with things like gains from selling assets or investments. That's not core operating performance.
Any other quick flags? Pensions. Capitalizing costs?
Yeah, pension accounting can be tricky. Underfunded plans can be a future drain. Overfunded ones can artificially boost current income. And yes, question when normal operating costs get capitalized, treated as an asset instead of an expense. Check the footnotes. How long do they really expect that asset to provide a benefit? Capitalizing costs makes current profits look better.
Man, okay, so given all these ways companies can, let's say, polish the numbers, how confident can you really be in reported earnings without doing these kinds of checks yourself?
It really drives home why Rule 1 is Rule 1. You got to do the homework. It puts the responsibility back on you, the investor.
Totally. Okay, let's move to rule number 2. Find economic moats. This is a concept Morningstar's famous for, right?
It really is. An economic moat basically is a sustainable competitive advantage. It's what allows a company to earn profits above its cost of capital for a long, long time by keeping competitors at bay.
Because success attracts competition, right? Everyone wants a piece of the pie.
Exactly. In a truly free market, high profits get competed away pretty quickly unless there's something protecting that company. A moat is that protection. It's what keeps a great company great instead of just fading back into the pack.
So how do you spot one? You look for those high profits consistently and then try to figure out why.
That's the process. First, look for the evidence. Consistently high returns on capital, strong free cash flow generation, healthy profit margins, high ROE, high ROA, sustained over years. That suggests a moat might exist. Then, you have to identify the source of that moat, what's actually keeping the competition out.
Okay, the book lists a few main sources. First one is product differentiation.
Right. Having a product that's truly unique, or at least perceived as unique by customers, maybe due to branding or features, think maybe certain luxury goods or powerful brands. But the book warns this is tough to maintain long-term, especially in tech or electronics where innovation moves so fast.
Makes sense. Next source, cost advantages.
This is about being able to produce or deliver your product or service cheaper than anyone else. It could be due to a better process or just massive scale allowing you to negotiate lower input costs or spread fixed costs wider.
Like Dell's direct model and scale giving them a cost edge in PCs back in the day.
Classic example. Or in basic industries like industrial materials, the book says you pretty much have to be the lowest cost producer to survive and thrive. Nucor and Steel is mentioned as a company focused on this.
Okay. Then, high switching costs. This one feels very real. Once you're embedded with a product or service.
It's a pain to switch. It costs the customer time, money, effort, or introduces risk if they move to a competitor. Think about professionals trained on specific software, like Adobe Creative Suite for designers,
Yeah, retraining is costly.
or ripping out and replacing a huge complex telecom network from a provider like, say, Nortel or Alcatel used to be. Huge undertaking, very risky for the customer.
Though the book notes switching costs aren't always high, like with some medical devices, if the procedure is similar across brands.
Right, it depends on the specifics. It's not a universal rule. Finally, there are high barriers to entry.
Things that just stop new competitors from even starting up easily.
Exactly. Maybe it's regulatory hurdles, like needing government licenses for broadcasting or banking. Maybe it's the sheer amount of capital required to build a factory, a network, or a distribution system.
Or the network effect, where the product gets better as more people use it.
Yes, like Cisco routers becoming the standard. The more people use them, the more valuable they became, creating a barrier for rivals. Training costs added a switching cost element too. Even just having a dominant position in a regional market, like some banks, can be a barrier.
The book then does a fascinating tour through different industries, looking at where you might find moats and where they're rare, like healthcare versus insurance.
Yeah, big contrast. Pharma can have wide moats from patents and brands, but R&D is a huge risk. Medical devices can have pricing power, but maybe shorter product cycles. But then you look at something like property and casualty insurance. The book says moats there are really scarce, the economics often pretty tough.
Or software versus hardware.
Another good comparison. Software, while competitive, can have great economics for winners. Think Microsoft's margins. Moats come from scale, network effects, high switching costs from installed bases. Hardware, though, much tougher. Brutal cycles, intense competition. Moats are rare, may be found in niche switching costs, cost leadership like Dell had, or network effects like Cisco.
What about media? The book seemed more positive there.
Generally, yes. Moats can come from things like geographic dominance, local newspapers, radio licenses, that's a barrier to entry, or scale in areas like publishing. Media often generates strong free cash flow, too. The pitfall noted was investing based on blockbuster hits, because entertainment production itself often struggles with profitability long-term.
It's really interesting how the source of the moat scale, brand, or whatever plays out so differently depending on the industry.
Totally. You have to understand the industry dynamics to understand the moat.
So here's a thought for you listening. Think about companies you use every single day. Your bank, your phone provider, the software you use, the stores you shop at. Which ones feel like they've really got you locked in? And what is it specifically that makes them so sticky?
That's a great exercise. Start noticing those moats in action.
All right, moving on to rule number 3. Have a margin of safety. The book is crystal clear. Finding a great company, even one with a wide moat, is only half the battle.
Only half. You absolutely cannot overpay, even for the best business in the world. Paying too much is probably the single biggest mistake investors make, and it guarantees poor returns.
So the margin of safety, it's basically buying a stock for significantly less than what you estimate it's actually worth, its intrinsic value.
Precisely. Think of it as a buffer or insurance. Your estimate of a company's future value is never going to be perfectly accurate. There's always uncertainty. The margin of safety gives you room for error. If things don't turn out quite as rosy as you projected, having paid less gives you protection.
The book mentions common valuation metrics: PE, PS, PB, price to earnings, price to sales, price to book. What's its take on using those?
It acknowledges them but highlights their limits. PE might be useful for comparing a stable company to its own historical PE range, but comparing across different industries or the whole market is really difficult because growth rates and risk profiles vary so much.
Right.
PS might be okay for cyclical companies with volatile earnings. Again, maybe compared historically. PB, price to book, the book argues, is much less useful today than it was for Ben Graham. Why? Because so much value now is in intangible stuff, brands, software, intellectual property that isn't fully captured on the balance sheet's book value.
So if those simple ratios have limits, what's the core valuation idea the book pushes?
It's the fundamental concept behind discounted cash flow, or DCF. The simple idea is that $1 of cash flow you expect to receive in the future is worth less than $1 in your hand today.
Okay, time value of money.
Exactly. And the further out in the future that cash flow is, and the less certain you are that you'll actually get it, the bigger the discount you apply, the less it's worth to you today.
And that explains why stable, predictable companies often get higher valuation multiples, because their future cash flows feel more certain.
That's a big part of it. Investors feel more confident, so they discount those future cash flows at a lower rate, making them worth more today. A rational investor inherently values current, predictable profits more highly than uncertain far-off promises.
And the size of the margin of safety you need, it varies depending on the company's risk profile.
Absolutely. A riskier, harder to predict business. Maybe a biotech company with drugs and trials, or an industrial company like Boeing, subject to big cycles, requires a larger margin of safety. Maybe you want to buy at 30%, 40%, even 50% below your estimate of its value.
Whereas a more stable, predictable business, like a consumer staples company, say Clorox or maybe Anheuser-Busch.
You might require less of a buffer, maybe 20% or 30%, because you have more confidence in forecasting their future results. The difficulty of predicting future cash flows dictates the necessary margin.
This rule feels so important because it forces discipline. It stops you from just getting swept up in excitement about a company's story and ignoring the price tag.
It shifts the focus entirely. The best way to reduce investment risk isn't market timing or fancy hedging. It's paying a sensible price relative to intrinsic value.
Value, not just story. Okay, rule number 4, hold for the long haul. This is the patience rule.
It is, and it's vital because, as we all know, short-term stock price swings are, well, they're wild and unpredictable. And often they have very little connection to how the actual underlying business is doing day to day.
But fundamentals do matter eventually.
Over the long term, absolutely. Company fundamentals, earnings growth, cash flow, returns on capital are what ultimately drive share prices. The book uses examples like Walmart's stock price growth slowing down when its business growth eventually slowed versus Colgate-Palmolive's steady stock gains reflecting its consistent business performance over many years.
And just the act of trading frequently.
Yeah,
It costs you money, right?
big time. Commissions, bid-ask spreads, and especially taxes if you're trading in a taxable account, those costs add up and are a significant drag on long-term returns. The book really encourages you to think of buying a stock like buying a major asset like a house or a small business. You plan to own it for a long time.
What about trying to jump in and out? Market timing. The book pulls no punches there.
Calls it a fool's game. Flat out. There's just no evidence that anyone can consistently time the market successfully over the long run. Decades of data show it doesn't work. Be extremely wary of anyone selling a system that claims to do it.
And related to that, panicking when the market plunges.
Usually the absolute worst thing to do. The book emphasizes that assets are often cheapest, precisely when fear is highest, when everyone else is desperate to sell. It quotes Sir John Templeton, "The time of maximum pessimism is the best time to buy."
It uses those amazing historical examples, doesn't it? Like that Business Week cover in 1979 proclaiming the death of equities right before a massive bull run.
Exactly. Or Barron's questioning Warren Buffett in late 1999, "What's wrong, Warren?" Just as the tech bubble was about to burst and his value approach was about to shine again, market sentiment is often most wrong at the turning points.
Morningstar's own study found that too, right? Hated asset classes tended to outperform loved ones.
Over rolling 3-year periods for over a decade, yes. It takes real courage to go against the herd, to buy when things look bleakest, but history suggests that's often when the best opportunities are found.
And here's a statistic from the book that really jumped out at me. Small growth stocks, the ones everyone hopes will be the next big thing, have actually been the worst performing category of stocks over the very long run.
It sounds wrong, but it's true based on long-term historical data, like going back to 1927. Their average annual return was significantly lower than the S&P 500. Why? Because while a tiny few become huge winners, the vast majority just fizzle out or fail. Picking the winners in advance is incredibly difficult, and you pay a high price for that hope.
Wow. So when you feel that market panic setting in, or you're tempted to chase some hot trend, how do you remind yourself to stick to the plan? How do you find that courage the book talks about?
You go back to your homework. Focus on the long-term value of the business you own. Remember the margin of safety you hopefully bought it with. And recall the historical evidence about the futility of market timing and the rewards of patience. Trust the process.
Trust the process. Okay, brings us to the final rule. Rule number 5. Know when to sell. This feels like maybe the hardest one for people. Letting go.
It often is. Emotions, greed when a stock is up, fear when it's down, really interfere with rational decision-making here. The book is adamant. You shouldn't sell just because the price moved. You need a fundamental reason tied back to the business or your original investment thesis.
Okay, so it provides a framework for that decision too. 5 key questions to ask yourself if you're thinking about selling. What's the first one?
First, ask, did I make a mistake when I first bought it? Did I get the analysis wrong? Maybe I underestimated the competition or overestimated management skill, or the growth potential just wasn't what I thought. If your original premise was flawed, based on new evidence, selling might be the right move. Cut your losses or correct the error.
Okay, makes sense. Second question.
Have the fundamentals of the company genuinely deteriorated? Is the actual business getting worse? Are sales consistently falling? Are profit margins eroding? Is debt piling up unsustainably? Has management started making questionable decisions? If the business itself is weakening, the reason you owned it might be gone. Has the stock price simply gone crazy? Has it risen so far, so fast, that it's now trading way, way above any reasonable estimate of its intrinsic value? Even the best company becomes a bad investment if the price gets totally detached from reality. If the market is pricing imperfection and then some, maybe it's time to trim or sell.
Lock in some gains when things get too frothy. Fourth question.
Can you find significantly better opportunities elsewhere? This is about opportunity cost. Your investment capital is limited. It should always be deployed in the ideas you find most compelling, offering the best risk-adjusted returns based on these rules. You find something much more attractive, it might make sense to sell a less attractive holding to fund the new purchase.
Okay, always looking for the best use of capital. And the fifth reason to sell.
Does the stock simply take up too much space in your portfolio now? Maybe it's been a huge winner and now it represents, say, 20% or 30% of your total investments. That introduces significant concentration risk. Even if you still love the company, prudence might dictate trimming the position just to manage risk. Diversification matters.
Those are very clear, logical reasons. But acting on them? Especially overcoming the emotional attachment or fear? That seems like the real challenge. Thinking about potential investments, which of those reasons to sell do you imagine would be the hardest for you personally to pull the trigger on?
It takes real discipline, doesn't it? Selling a winner because it's overvalued or admitting a mistake on a loser? Both go against our instincts.
Yeah. So let's wrap up this book talk on the 5 rules for successful stock investing. Rule 1, do your homework. Rule 2, find economic moats. Rule 3, have a margin of safety. Rule 4, hold for the long haul. And Rule 5, know when to sell. Taken together, it's a really solid framework.
It truly is. It fundamentally shifts your perspective. You stop speculating on squiggly lines on a chart and start thinking like a business owner. It's about understanding quality, assessing value, being patient, and acting rationally based on fundamentals, not just noise and emotion.
And applying these rules, it really forces you to think for yourself, doesn't it? To think critically, independently, and focus on the long game. It's about becoming a student of business, not just the stock market.
It turns investing from, well, maybe gambling, into actually owning a piece of a real enterprise.
Yeah. And the great thing is, these rules aren't some secret code only Wall Street insiders can use. They're a powerful way for you, for anyone, to look at the businesses all around us and make smarter, more informed decisions with your money. So maybe a final thought for everyone listening. What's one thing about a company you're curious about right now that you could start doing your homework on, using these rules as a guide?
Even just starting with one company, applying one rule, it's amazing how it changes how you see things. A little curiosity, a little homework goes a long way.
That's a fantastic place to leave it. Thank you so much for joining us for this deep dive and this special book talk. We really hope these principles help you approach investing with, well, more confidence and clarity.
Start putting them into practice. See what happens.
And hey, if you found this discussion valuable, if you want to keep getting informed quickly and deeply on more fascinating topics like this one, please hit that subscribe button for the deep dive.
Yeah, subscribing means you won't miss out on future insights and discussions.
Absolutely. Until next time.
Keep digging.